You all are cordially welcome to our webinar series once again. We are moving on to a very simple concept today, and this is quite familiar with all of you all. This is a topic which we have started learning right from A level. So, what is it? A simple topic. Cash flow statements. Cash flow statements, but this is not how the name is read now. This is read as the statement of cash flows now, and that is the name given by the standard. What is the relevant standard for the cash flow statement? Should be LKAS 7. LKAS 7. Included in a complete set of financial statement should be a cash flow statement as well. Now, I will not get into the technical discussions of the aspects of LKAS 7 right at the beginning. I will teach you how to prepare a cash flow statement at the first place, at the outset, and having understood the basic requirements in preparing a cash flow statement, and then we can move on to the discussion of the technical aspects of the cash flow statements, and that should be the correct path and correct sequence of lining up our discussions. We will first discuss our cash flow, the techniques required to prepare the cash flow statements, and then we will start discussing the important areas of the standard LKAS 7. Now, what is a cash flow statement? In a very simple language, which all of us will understand, the cash flow statement is a small single paper where the cash receipts and the payments are included. Come on. Someone who is not from the accounting background, or someone whose accounting knowledge is not as good as yours, will be thinking, so why do we need to prepare another statement called the cash flow statement? Because we already have that with us. It is the cash book. That is where all the cash receipts and the cash payments are recorded and included. So, why are we going to duplicate our work by preparing another statement called the cash flow statement? So, why can't we use the cash book instead of using the cash flow statement? You know, the cash book of a company can be the biggest prime entry books of an entity, and that can run into thousands of pages, sometimes 10,000, 15,000, depending on the volume of the transactions. Sometimes if an entity maintains more than one current account, some companies do have 10, 15 current accounts. For each current account, you need to maintain a separate cash books, and if you have 10 current accounts, obviously you need to maintain 10 cash books. And just imagine all these cash books being merged together, and just imagine how big that combined or the merged cash book will be, and it is not at all possible to present it as part of the financial statement. Such a massive book running into 10,000, 15,000, 100,000 pages sometimes will not be practically possible. And also, since the cash flow statement is part of the financial statements, in the conceptual framework do we learn that the financial statements need to have certain characteristics, and the informations, the detailed informations, the levels of details at which the transactions have been recorded in the cash books do not include and do not consist the required and the desired characteristics of the financial statements as required by the conceptual framework. And these cash books, the entire set of cash books, will be rearranged into a single paper in the name of the cash flow statement. So, you need to understand the fact that this cash flow statement is nothing but the cash book itself, but it is only just that. This cash flow statement is more concise than the cash book, and the figures and the informations in the cash flow statement is more logically arranged than the arrangements of transactions in a cash book. So, those are more, it is more analytical. The informations in the cash flow statements will be more analytical than the arrangements of transactions in the cash books. So, there are a lot of advantages of preparing a cash flow statements, which I won't discuss right now. So, we will just keep it aside for the moment, and let me straight away take you through the techniques and the mechanisms of preparing a cash flow statements, and then we will come back to those required areas in the standard LKAS 7. Sometimes even in at your client place, or even at the place, working place where you work, you would have had this weird experience of not being able to balance in the cash flows, and we all had that experience in our life at some point in your life. Are we going to make use of the cash book to prepare the cash flow statement? Not at all. So, you are supposed to prepare a cash flow statement even without touching the cash book, even without calling the name of cash books. You need to prepare the statement of cash flows even without touching the cash books, even without calling the name cash books. It is going to be a simple exercise. And somebody might have a feeling, a wow kind of a feeling, how is it possible for us to prepare a cash flow statement without even touching the cash book? Yes. I will give you a simple example. For you to prepare a cash flow statement, you need not to have a cash book, and simply if you have the balance sheet at the beginning of the current year and at the end of the current year, that is what is required, that is more than enough. But if you have some other informations taken from the profit and loss, we can make it more detailed. But even if you have two balance sheets at the beginning and at the end of the period, still you can prepare a cash flow statement to some extent. How can we do that? Let me give you a simple example. Say we are given the balance sheet at the beginning of the year, say 1st January 20. Also, we are given the balance sheets towards the end of the year, 31st December 20. Property, plant and equipment. Beginning balance is 100,000, closing balance is 150,000. Investments, beginning balance is 40,000, closing balance is 60,000. Current assets, inventories, beginning balance is 60,000, ending balance is 30,000. Trade and other receivables, opening balance is 80,000, closing balance is 25,000. Cash and bank, beginning balance is 20,000, closing balance is 45,000. Total assets, $300,000 at the beginning, ending total assets 310,000. ordinary share capital, beginning balance 70,000, ending balance 90,000. Retained earnings, beginning balance 35, ending balance 75. Non-current liabilities, under that say bank loans, beginning balance 90,000, ending balance 40,000. Debentures, beginning balance 30,000, ending balance 60,000. Current liabilities, trade payables, beginning balance 75, ending balance 45,000, 310,000. So, this is what has been given. So, nothing else is given other than the opening balance sheets and the closing balance sheet being given, and you are supposed to prepare a cash flow statement, and you have to do some miraculous things to prepare a cash flow statement with only the opening balance and the closing balance sheets being given, nothing else is given. What if the cash book for the year had been given? What would have been the opening cash balance if you had been given the cash book for the current year? What would have been the opening balance? Simply the opening balance has to be 20,000 rupees. Similarly, if the cash book for the year had been given, what would have been the closing balance? The closing balance would have been 45,000. In other words, right during the current year, the total cash receipts has been higher by 25,000 rupees than the cash payments. Your cash inflows have been higher by 25,000 rupees than the cash outflows. If I prepare a concise, very brief cash book, which is not as detailed as the original cash book we would have maintained, this is how it looks, and let me bring the opening balance. Opening balance is 20,000 here, let me establish the opening balance, and the closing balance has to be 45,000, say this is the closing balance, 45,000. And you can turn these two balance sheets upside down. The opening cash balance and the closing cash balance are different from each other by 25,000. And if you simply apply just a mathematical approach to prepare the cash flow statement, the differences of all the other figures in these two balance sheets should be equal to the difference between the opening cash balance and the closing cash balance. The figures of these two balance sheets have been arranged in such a way that the difference between the opening cash balance and the closing cash balance should be equal to the total of differences of the other items of the opening balance sheet and the closing balance sheet. Let me prove it now. But let me do a small assumption here. What is the assumption? All the transactions were connected to cash. All the transactions were cash related transactions. I want you to make the same assumptions. All the transactions were cash related transactions. Opening property, plant and equipment 100,000, closing 150. So, what do we simply assume? The difference of 50,000 wouldn't have been due to anything else but due to the acquisition of assets, since nothing else is given. Since no any other information is given to the contrary, what do we simply assume? Whatever the difference between the opening and the closing balances of the balance sheets would have been related to cash, they are all cash related transactions. So, 50,000 would have been the amount of property, plant and equipment acquired for cash during the year. Simply, I will credit cash and debit to property, plant and equipment. I am preparing the cash book, which is not as detailed as the cash book you would have maintained in your business. Original cash flows, to some extent let me prepare a summarized and a concise cash book. Investment. Opening is 40 and the closing is 60 and the difference is 20,000 rupees. Since no any other information is given to the contrary, I do simply assume that this difference of 20 would have been due to the acquisition of investments during the current year. Simply once again you credit to cash account and debit to investment account by 20,000. Inventories. Opening balance 60 and the closing is 30. Inventories have dropped, that would have been due to so many reasons. But the questions of the examiner does not give us any supporting evidences, in the absence of which we can reasonably assume that the drop in inventory value from 60,000 to 30,000 is not because of anything else but due to the sale of inventory. Credit to inventory account and debit to cash account 30,000. Inventory. Trade receivables, opening balance 80 and the closing is 25. And this drop of 55,000 has not been explained. So, in the absence of any supporting explanations given to the contrary, what do we simply assume? 55,000 drop in debtors would have been due to the settlement of debtors in cash. You credit to debtors account and debit to cash account by 55,000. Debtors. Cash balance already we have taken. All ordinary share capital, opening 70 and the closing 90. Obviously, there has been a share issue for cash of 20,000. Credit to share capital and debit to cash account by 20,000. Share capital. Retained earnings, we will simply assume, for the purpose of explaining this concept to you all guys, simply assume that the profit was purely on the basis of cash. Opening cash balance is 35 and the closing cash balance is 75. So, the profits have increased by 40,000 due to receipt of cash. I will debit to cash account by 40,000, credit to profit and loss account by 40,000, profit and loss. Bank loans, opening 90 and the closing is 40. What has happened? The bank loan has reduced by 40,000. What do you think? What do you think it has taken place? The entity has settled 50,000 worth of bank loans, so you can credit to cash by 50,000, debit to bank loans by 50,000. Bank loans. Debentures, opening 30 and closing is 60. What do you think would have happened? We have gone for a debenture issue during the current year at the tune of 30,000, you can credit to debentures and debit to cash account by 30,000 rupees. Debentures. Then trade payables, opening 75 and the closing 45, drop is 30,000 rupees. What do you think has happened for trade payables? We would have settled to trade payables by 30,000. So, you can credit cash account by 30,000 rupees and debit to trade payables by 30,000. Now, this debit transaction total and the credit transaction total in this small summarized concise cash account they have to tally to each other. So, let me see whether it is tallying. 0, this is 5, 7, 9, 14, 17, 195, 100, this is also 195. And this is something very close to the original cash book you would have maintained in the business, but it is not, this cash book is not as detailed as the cash book you would have originally maintained in the business. And as I said, the cash flow statement we prepare as a part of the complete set of financial statements need not to be as detailed as the original cash book we have maintained. The figures in this cash book can be derived or can be used to prepare a cash flow statement as required by LKAS 7. What I am trying to tell you is that for us to prepare a cash flow statement, never do we use the cash book. And if you start preparing a cash flow statement using the cash book, that will be the most tedious and the tiring exercise ever in the world. And you can never finish doing that. You need to start turning 100,000 pages sometimes. And you need to read each and every single transaction recorded in the cash book one by one. And even just within 1 year's time you can't finish it. So, we will make use of only the balance sheets and the profit and loss statements and the equity statements to extract figures to the cash flow statements. And if you prepare the cash flow statement, we are prohibited even from calling the name of cash book, and you are supposed to prepare the cash flow statement only by using opening and the closing balance sheets, the profit and loss for the period and the statement of equity changes, and that is it. But now, some of the assumptions we made are not the realities at the ground level. Now, let me start from this part: property, plant and equipment opening 100, closing 150. And this increment of 50,000 was reasonably simply assumed to be the amount of 50,000 assets that would have been acquired for cash, which is not the case sometimes, and that would have been due to some assets granted by the government, or it would have been sometimes due to acquisitions of assets by issuing shares, or it can be sometimes acquisition of assets in an exchange transaction. So, maybe sometimes revaluation of assets, and there can be depreciations in that, there can be sometimes impairment losses in that. So, what and what can be included in this total difference of 50,000? So, you need to dive deep down to each and every items of transactions that cause this difference of 50,000 without just simply assuming that 50,000 is due to the acquisition of assets for cash during the year, and that is not the reality at the ground level. For you to do that, the question should be detailed enough. Now, even investments, this difference of 20,000 would not have only been due to the acquisition of investments, there would have been sometimes fair valuation. fair value increase would have been 20,000, and there can be a lot of other reasons, and this 20,000 was simply assumed to have been due to the acquisition of investments for cash, which is not the case and the reality at the ground level. So, we need to dive deep into the each and every single transactions that will constitute this total difference of 20,000, and the most problematic item is the profit figure. Never can we assume that this profit of 40,000 was due to the receipt of cash by 40,000. Why? Never do we prepare and calculate the profit on cash basis. That is the opposite of accrual basis. Profits are always on accrued basis, not on cash basis. So, this is the most problematic area. This profit figure of 40,000 has to be further purified and filtered into accrued basis from the cash basis, and that is what we need to start doing first without looking at anything else. So, let me start from there, will you? This profit figure of 40,000 cannot be considered or cannot be assumed to have been due to the receipt of cash. Why? Your profit calculations are based on accrued basis, not on the cash basis, and let me touch the other remaining items in a little while after sorting out and fixing this matter, retained earnings, how you convert this 40,000 profit figure on accrued basis to the cash basis. Simply by comparing the opening and the closing balances, we get a difference of 40,000. This 40,000 difference is not cash based profit, it is accrued based profit. Now, to the cash flow statement, the profit to be taken should not be this accrued basis profit, it has to be the cash based profit. So, I should start my exercise of transforming and converting this accrued based profit to the cash based profit, and that is the most important part. That is the be all and end all in this exercise. That's the bread and butter in your discussions. You need to keep concentrating on these explanations. If you get it right, everything else in the cash flow statements will be just simple, will be just a simple exercise, and this is going to be the most important part. So, now we are going to start our exercise of transforming and converting accrued based profit to the cash based profit. You know, if somebody sees the profit and loss balance, the net profit figure is not the amount of cash balance in your cash account. Your cash account balance will be something else, whereas your profit figure will be completely a total different figure. Now, we are going to make it or rather we are going to reconcile it how your accrued basis profit figure will be different from the cash basis profit figure. In this exercise of transforming your accrued basis profit to the cash basis profit, how many adjustments to be done, or how can you convert and transform that into the cash basis profits? Remember, and trust me hand on my heart, you need not to do so many adjustments, maximum you need to do 3 adjustments, 3. What are these 3 adjustments? And if I just throw that questions to the audience in a physical class, what kind of adjustments are we supposed to do to convert this accrued profit to the cash profit? The quick and the most immediate answer I get from the audience is the depreciation. That's only just an example, and let's see how this happens, or this exercise of transforming cash basis, accrued basis profit to the cash basis. As I said before, you need to incorporate only 3 adjustments, nothing more than that, just 3. How many? Just 3, and let me explain one by one. What are these 3? There can be non-cash transactions, non-cash. The non-cash transactions we have taken to profit and loss in calculating the profit will be of multiple numbers. But then once again, it can be further taken into 2. What are the 2? All the provisions and the profit or loss on asset disposal. The number of provisions you create in arriving at this accrued profit can be once again infinite and endless. All the profits, all the provisions in common are non-cash transactions. You need to remove the effect of all the provisions to transform the accrued profit to the cash profit, and you can give me as many examples as you like for provisions, starting from provision for depreciations, and that is the most famous and the popular example for provisions. It can be the provisions of depreciations, it can be the provisions for doubtful debts, it can be the provisions for impairment, it can be the provisions for gratuity, it can be the provisions for obsolescence of inventories. So likewise, there can be many more provisions. All these provisions are just mere book entries, and it does not get involved in cash, and all these provisions would have brought down our cash profit. To convert your non-cash profit back to the cash profits, you need to eliminate the effect of all these provisions. It can be depreciations, it can be doubtful debts, it can be the provisions for impairment, it can be the provisions for gratuity, it can be the provisions for obsolescence, it can be the provisions sometimes created for possible compensations in a lawsuit, legal cases, each and every, and that is not the exhaustive list of provisions, there can be some more, and all the provisions by and large has made your actual cash profit different from accrued profit, and you need to eliminate the effect of all these provisions to transform this accrued profit back to the cash profit. So here let me say one, in the first layer, do we take the provisions which are non-cash transactions, provisions need to be adjusted, provisions. So basically, all the provisions need to be added back. Why? The provisions you created would have brought down your actual profit. I said non-cash transaction is the first one, out of which provision is one category of non-cash. What is the second category? Profit or loss on disposal of assets. Let me take a simple illustrations to show the second aspect of non-cash transaction. Say we had an asset of 100,000 which was sold at 150,000 rupees during the year. So the profit you earn from the sale of asset is 50,000. and it is this 50,000 you should have included into accrued profit, but the cash element of this transaction should not be 50,000, the cash element should be 150. So, what is included into the profit calculation, net profit calculations for the period is not the receipt of cash of 150,000, instead you would have included 50,000 profit figure. Then on this non-cash transactions, let me remove the profits or losses on assets disposal. Asset disposal. Losses need to be added back to the accrued profit, and the profits need to be deducted from the accrued profit in transforming this accrued profit to the cash profit. So, one particular adjustment is complete, what is it, non-cash transactions. Under non-cash transactions there are two aspects. What are these two aspects? Provisions and asset disposal profits or losses. Second, there can be deferred items, deferred items, and we have heard of deferred revenue, we have heard of deferred taxes. Even once again, those deferred items have got very little to do with the cash transactions. Let me explain how it happens. Say we received a government grant of 100,000 rupees in cash to buy an asset. In receiving this grant, what you have done is you have debited cash account and credited to deferred revenue first, and this deferred revenue will be released to profit and loss using a method which is consistent to the method of depreciation of the asset to which the grant was received. Say we depreciate the asset on straight line method, and so should be the pattern of releasing this government grant to profit and loss. It has to be straight line method, and this deferred revenue 100,000 need to be released to the profit and loss over a period which is similar to the period of depreciation of the asset to which the grant was received. So, the asset is depreciated over 10 years time. Similarly, this grant is now released to the profit and loss over 10 years time. So, during the current year, we have added to the current year profit only by 10,000. The balance 90 is still remains in deferred revenue. Your total cash receipt is 100,000 rupees. 10,000 only has been added to the current year profit though. And if you did the profit calculation purely on the cash basis, the amount to be included to the profit account wouldn't have ever been 10,000, would have been how much? 100,000. Then in transforming your accrued basis profit to the cash basis profit, the remaining balance of this deferred revenue also has to be added to the current year profit. Deferred items need to be adjusted in transforming your accrued basis profit to the cash basis profit. I said there are only maximum 3 adjustments basically in a simple cash flow statement. I mean, in a simple questions of cash flows where you are supposed to transform this accrued profit to the cash profit. The third adjustment is what? That is the most complicated one. There can be accrued adjustments. and this is the most pervasive adjustments. It's the effect of accrued adjustments, the effect of accruals are scattered all over the profit and loss, starting right from sales right up to the profit after tax figure. So you need to sort it out very carefully. So let me explain one by one. Accrued adjustments. Now say we have a net profit figure of 500,000, net profit after tax 500,000, and our sales figure is altogether 1 million, out of which 400,000 is credit sales and the balance 600,000 is cash sales, cash. It is this accrued basis concept that requires you to recognize 400,000 credit sales as well as 600,000 cash sales. If you did the profit calculations purely on cash basis, you would have obviously taken only the cash element of 600,000 by ignoring credit element of the sales transaction of 400,000. And if your profit calculation was purely based on cash, your net profit figure wouldn't have been 500,000, would have been only 100,000, because if you did the profit calculations purely on cash basis, your sales figure would have been only 600,000. We would not ever include 400,000 credit sales figure into the profit calculation. So your net profit figure has to be, would have been 100,000 rupees. Now what do we need to do? In converting your accrued basis profit to the cash basis profit, you need to eliminate the effect of your accrued sales transaction. Accrued sales. What is the value of your accrued element of your sale transaction? 400,000. How do you measure the accrued element of your sales transaction? Very simple. We will forget about the opening balance sheet, and if you show debtors balance of 400,000 in the balance sheet, that shows, that demonstrates the credit or the accrued element of your sales figure. So debtors figure is nothing but the element of accruals of sales for the period, and you need to eliminate that 400,000. So debtors, close-in debtors need to be adjusted. Why are we adjusting the close-in debtors to the profit figure? It's not because of anything else, just to convert your sales figure included in the profit calculation from accrued basis to the cash basis. If you do this adjustment of debtors to the profit figure, simply the sales included in your profit figure will get transformed from accrued basis to the cash basis. And with this adjustment of debtors, the sales figure included in your profit is no longer on accrued basis, now it is on cash basis. Then, in calculating your profit figure for the period 500,000, what you have deducted is not the purchases on cash basis, you have deducted simply what? Cost of sales. Right within this cost of sales figure are there so many non-cash transactions. So what I will first do is, cost of sales figure need to be transformed back to the purchases. Why? What is involved with cash is not the cost of sales, but should be the purchases figure. Then to calculate for me to calculate the purchases figure, what I will do is I will convert the cost of sales figure into the purchases figure. How will you do that? Take the cost of sales plus closing stock minus the opening stock, and then you get the answer. What is it? It has to be the purchases. So, let us say the purchases are 400,000, total purchases, out of which 300,000 rupees has already been paid and 100,000 purchases were purely on credit basis. We did the purchases, but the payments are still due. In doing the profit calculations, what we have deducted is not just the 300,000 purchases on cash basis, also we have deducted 100,000 non-cash purchases, accrued element of purchase. Accrued element of purchase is how much? 100,000. What if you did the profit calculation purely on cash basis? Then you would have deducted only 300,000 cash basis purchases, you wouldn't have deducted 100,000, and if you did the profit calculations purely on cash basis, your profit figure wouldn't have been 500,000, your profit figure would have been how much? 600,000. Then here I will first adjust the inventory here. Inventory. Why are we adjusting inventory here? Please don't take the wrong end of the stick and you need to get it right. What requires you to adjust the inventory figure to the profit figure is not because the inventories got involved with cash. By adjusting inventories figure, what we simply do is we will transform the cost of sales figure included in your net profit to purchases. Then again we are adjusting creditors here. Why are we adjusting creditors here? Because the purchases which are on accrued basis now in the profit, the purchases which are included on accrued basis in the profit calculations is transformed and converted from accrued basis to cash basis now. Then after adjusting debtors, after adjusting inventories, after adjusting creditors, the profit figure is now converted to cash basis from accrued basis to some extent. What is that extent? That is, the gross profit is no longer on accrued basis. Now the gross profit has to be on cash basis now. Then we have, say, operating expenses. Right below the gross profit, we will just forget about other income for the time being. You have operating expenses. Now, as you determined operating expenses in the profit and loss, once again there would have been accrued elements. Say expenses we have taken to profit and loss is 200,000. Right towards the end of the year, we had 50,000 worth of expenses for which the payments were still due. Towards the end of the year, we had consumed 50,000 worth of services, but we had never settled. Those expenses for a value of 50,000 were debited to expenditure account and credited where? Credited to accrued expenditure. What if you had calculated your net profit figure on cash basis? Then your expenditure figure would have been 150,000, and what did I say my net profit figure was for the current year? 500,000. Then if you did the profit calculation purely on cash basis, your net profit figure wouldn't have been 500,000, would have been 550. Why? I recognize only the cash payments into my expenditure. If my cash basis if my profit calculation was purely on cash basis, so accrued expenditure for a value of 50,000 should be adjusted back to the profit calculation to simply transform accrued basis profit to the cash basis. I am adjusting here accrued expenditure Y to eliminate the effect of accruals of expenditure now. Then in your balance sheet we have prepaid expenditure of 100,000. What does it say? We have done the payments in advance for the services to be received in the future, the services to be received ahead, but we have already done the payment. Those payments of 100,000 have not been expensed to profit and loss. Instead, they were recognized into another asset called prepaid expenditure. Even prepaid expenses appear in your balance sheet because we recognize the profit. We do the profit calculations on accrued basis. If you did the profit calculations on cash basis, your expenditure figure would have been 300,000. Why? Even this 100,000 payments of cash would have been recognized into expenditure irrespective which period they are relating to, despite of the fact which period those expenses payments relate to. Even 100,000 would have been recognized into expenditure. My expenses would have been 300,000 and my profit figure would have been 400,000. Now I will adjust here prepaid expenditure as well to the profit figure. So let me limit my examples to those few items, 5 items now. Now your profit figure, which profit? Your operating profit or the profit before tax and interest is no longer at accrued basis, that is at cash basis. For the God's sake, remember, you would have learned different things at different levels of your studies before. Please remember, we adjust debtors not because of anything else but to transform your sales from accrued basis to cash basis. Why are we adjusting inventories here? Not because of anything else but to transform your cost of sales into the purchases. Why are we adjusting creditors here? Not because of anything else but to transform your credit purchases into cash basis. Accrued expenses and prepaid expenses, why are we adjusting them to profit? Because you need to transform your, or you need to eliminate the effect of accruals of expenditure and to transform your accrued basis profit to the cash basis profit. So those are the reasons. Now here your profit figure should be, which profit? Your profit before tax and interest should be on cash basis. Then you can simply take here interest on cash basis, deduct it, and you can take your tax payment on cash basis, deduct it, and then simply you get the net profit after tax, on cash basis. So this is as simple as that. I don't think this is hard. This is hard, just a matter of thinking. Now even the format to some extent in LKAS 7 has been designed in a way that the profit on top on accrued basis will get converted and transformed into cash basis by incorporating all these required adjustments, and let us see how it is done as we start discussing the formats of cash flows in LKAS 7. So we are moving on to the questions, and then we will get back to LKAS 7 discussion. Now cash flow statements can be prepared in 2 ways: indirect method and direct method. And those 2 methods are not completely too different from each other. It is only just that one area of the format will be different under direct method from the format under indirect method. So let me first discuss some questions under direct, that is the most popular method, and after completing the questions under direct method, we are moving on to the discussions of questions on direct method. We will go to question number 1. Question number 1. The following financial statements were taken from the books of APLC for the year ending 31st December 2020 along with its comparative figures. First we are given the comparatives and then the current, that is all right. Non-current assets are given: property, plant and equipment 647,725, fair value through OCI investments 100,000, 145,000, intangible assets 60,000, 105,000, investment properties 48,000, 55,000, current assets inventories 127,000, 141,000, trade and other receivables 248,000, 397,000, prepaid expenses 35,000, 15,000, cash and cash equivalent 172,000, 198,000, ordinary share capital 350,000, 400,000, retained earnings 315,000, 390,000, fair value change of investments 90,000, 100,000, debentures 210,000, 175, long term bank loans 140,000, 100,000, deferred tax liabilities 75,000, 90,000, current liabilities trade payables 105,000, 183,000, accrued expenses 54,000, 81,000, tax payables 88,000, 92,000, current portion of bank loans 10,000, 170,000. Extracts of the profit and loss for the year ending 31st December 2020. Profit before tax and interest 240,000, interest 23,000, profit before tax 217,000, taxation 44,000, profit after tax 173. Other comprehensive income, fair value change of investments 10,000, total comprehensive income is 183,000. Depreciation or the following information is given. Depreciation charge for the year is 35,000. An asset with a carrying value of 45,000 rupees was sold at 78,000 during the period. There were no disposals of investments or investment properties during the year. Intangible assets were amortized by 12,000 rupees during the year. Investment properties are carried at fair values and the amount of fair value charges recognized during the year is 7,000 rupees. You are required to prepare cash flow statement for the year ending 31st December 2020 using the indirect method. Cash inflows and outflows are listed under three activities, namely operating activities, investing activities and financing activities. Of all these three activities, operating activities is the category to be first taken to the cash flow statement, and there are reasons. We will explain the reasons in a little while when we discuss the formats of LKAS 7. say cash flows from operating activities, cash flows from operating activities. This is where you transform your accrued based profit to the cash based profit. So, let me take the profit figure here. The profit to be taken here should be the profit before tax. Say profit before tax, and this is taken from the profit and loss. This is on accrued basis. So, now we start transforming this from accrued basis to the cash basis. So, how many adjustments to be done? 3 adjustments. What are these 3 adjustments? Non-cash, deferred and accrued adjustments, and say here adjustments, and this is where you incorporate the adjustments of non-cash, adjustments of deferred, and then you get an answer. We call it profit before working capital changes. Profit before working capital changes. What do you mean by working capital? Working capital is the difference between the current assets and current liabilities basically. So, what do we include under current assets and current liabilities? Basically inventories, trade receivables, prepayments, cash and cash equivalent, accrued expenses and so on and so forth. So, it is under current assets and current liabilities where the effects of accrued transactions are recorded. So, inventory should be part of, or inventory has to be the effect of accrued transactions. Debtors should be a part of or the element of accrued transactions. The debtors is the accrued element of accrued element of the sales, and the prepayment should be the accrued element of expenditure. Accrued expenditure once again should be the accrued element of expenditure, and prepayments, then debtors, creditors should be the accrued element of the purchases. So, most of the items listed under current assets and current liabilities should be the accrued element of the transactions. So, here working capital changes are the effects or the elements of accrued transactions. Now, under this part, what will I list? The items to be listed under this caption or the working capital changes should be the effects of accrued transactions, and this is where I will show the changes of inventories, this is where I will show the changes of debtors, this is where I will show the changes of trade payables. I will start listing down the accrued elements of the transactions under working capital changes. Why are we doing that? We are eliminating the effects of old accrued transactions once again to further filter out the accrued profit and then to convert that into the cash profit. I hope it was clear. Then here we will get operating profit on cash basis, operating profit. Then we will deduct here interest payment. I will explain this part, interest paid, and say tax paid, then we will leave some space here, then say cash flows from investing activities, we will keep some space to include the transactions items here, and last item cash flows from financing activities, cash flows from financing activities, right. So, we will start with the adjustments given. Depreciation charge for the year is 35,000 rupees and assets with a carried value of 45 was sold at 78,000 rupees. Now, you need to listen to this. Say opening property, plant and equipment 100, closing is 150. In the absence of any information given to the contrary, we will simply assume that this difference of 50,000 was due to the acquisition of assets for cash during the year. But now the examiner says the entity has charged 30,000 rupees depreciations during the current year. Now, if not for the acquisition, the closing figure of assets would have been 70,000. Why? Opening property, plant and equipment 100,000, deduct depreciation of 30 and the closing balance would have been 70,000. So, that 70,000 that would have been if not for the acquisition has now become 150,000. So, the acquisitions of assets for cash during the year cannot be just 50,000 rupees, has to be now 80,000 rupees. The more items that are included, the harder it is to identify the cash element in this method, in this way. So, then just to make our thinking pattern more comfortable or just to make our calculations more convenient and comfortable, without doing this calculations in this way, we will resort to open up T accounts where the cash elements of the transactions can be easily determined. We will open up the required T accounts everywhere where there are transactions, and let us find out the cash elements of transactions then. So, let me open up property, plant and equipment account and asset disposal account. Disposal, property, plant and equipment account and asset disposal, and you need to be little careful. My handwriting will not be so clear sometimes because I need to have space. I have limited space and you need to you need to zoom the video and watch it. If not, my writings will not be so clear. So, let me bring the opening and closing balances. Opening balance of property, plant and equipment 647,647. Closing balance has to be 725. You can put the balance here, also balance. And what does the first adjustment say? Depreciation charge of 35,000. What is your simple double entry? You need to credit to property, plant and equipment account and debit to profit and loss. So, ladies and gentlemen, let me bring the profit before tax figure here straight, 217,000. So, this profit figure 217,000 is also after deducting interest, after deducting the operating cost of administration and distribution. Obviously, 217,000 profit for the current year would have been calculated after deducting the depreciation of how much? 35,000. And in my previous explanations, right at the outset, I explained the fact that this depreciation is a provision which does not get involved with the cash movement. To convert this non-cash profit to the cash profit, what do we need to do? Depreciation figure need to be added back. 35,000 depreciation should be adjusted back, should be added back. Under this area, here we will incorporate non-cash and deferred. Here we will incorporate accrued element, so in other words working capital. Then you get the operating profit. Then separately you should calculate the amount of interest payments and tax payments in cash, and then you will bring them here to further calculate your profit after tax on cash basis. Right. What else does adjustment number 1 talk about? An asset with a carrying value of 45, carrying value of 45 has been disposed of, will eliminate that from the asset account. Disposal, credit to property, plant and equipment by 45, debit to disposal by 45,000, credit property, plant and equipment, debit disposal by 45. So, what does it say the selling price has been? 78,000. You debit cash and credit to disposal by 78,000. This 78,000 has been received in cash in this disposal transaction. You need to bring that 78,000 to cash flow statement under investing activities. So, you will wonder why investing activities, and that particular logic has still not been explained. So, let me explain that as I start discussing LKAS 7. 78 should be a cash inflow, say proceeds from the disposal of property, plant and equipment, should be a cash inflow. Then let me close up this disposal account. 78,000, the balancing figure 33,000, what is it? A profit. Now, the current year profit of 217,000 obviously would have been calculated after including this disposal profit of 33. As I said at the outset in my earlier explanation, this 33,000 cannot at all be a cash transaction. The cash element of this disposal transaction is not 33,000, it is 78,000. Since 78,000 is already taken to the cash flow statement, you can't let it to be, you can't let this 33,000 to be further included in the profit figure. You need to take it out. If not, this disposal transaction is duplicated. Like, I am removing this 33,000 disposal profit from the profit figure to further transform that from accrued basis to cash basis. Disposal profit of property, plant and equipment, 33 was deducted. So, let me remove this disposal account since I want to have more space, and let us continue with adjustment number 2. There were no disposal of investments or investment properties during the year. Disposals of investments or investment properties. Investments, fair value through OCI investments 100,000, opening balance, and the closing balance is how much? 145,000. And since there were no disposal, this entire 45 would have been either acquisition of assets or due to fair value changes. I do not know what it is, so just leave it aside for the moment. Also, investment properties, opening balance is 48 and the closing balance is 55, so the change is 7,000 rupees. I do not know whether it was because of fair value increase or acquisition. Let us leave that also aside for the moment and we will proceed to adjustment number 3. Intangible assets were amortized by rupees 12,000 during the year Let me open up a simple T account for intangible assets and let us incorporate opening and closing balances. Intangible assets opening balance 60,000, closing balance 105,000. Amortizations of intangibles during the year were 12,000 credit to intangibles, and this is debited to profit and loss. 217,000 current year profit before tax invariably would have been calculated after deducting the amortizations of intangible. This is more or less the depreciations of property, plant and equipment, a provision. So 217,000 is deducted by this 12,000 non-cash amortization, need to add it back to further transform this non-cash profit to the cash profit, say intangible assets amortization. 12,000 is added back to transform this non-cash profit to the cash profit. Fourth adjustment, investment properties are carried at fair value and the amount of fair value charges recognized during the period is 7,000. So, let me take investment properties now. Opening balance is 48,000, closing balance is 55, change is 7,000. That is what adjustment number 4 explains about, rather. That is what adjustment number 4 explains about. This increase of investment properties from 48,000 to 55 is due to the increase in fair valuations by 7,000. You debit investment properties by 7 and credit to profit and loss by 7,000. And this fair valuation is non-cash transaction, and to convert your profit from accrued basis to cash basis, you need to eliminate its effect, 7,000. Say fair value change of investment properties, 7,000, right. So, it is like a provision. If you provide for this change of fair values of investment properties in the market, you debit to investment properties and credit to profit and loss. So, the current year profit 217 is obviously after including the fair value changes of investment properties. So, it was taken off now, eliminated to further transform your non-cash profit to the cash profit by 7,000. Then the adjustments were done. So, we can get back to the balance sheets and let us see what the remaining figures are, and then by comparing the remaining figures of the balance sheets and the profit and loss, you can further find out the required cash transactions to be taken to the cash flow statement. Property, plant and equipment I have taken. Fair value through OCI investments, and let me open up a simple account for investments, fair value through investments, fair value through OCI investments. Opening balance is 100,000, closing balance 145, and if you see the profit and loss extract under OCI, have they shown the fair value change of investments? Obviously, that 10,000 fair value change must be the fair value change of fair value through OCI investments. You can debit that to investment account and credited already where? To OCI. So, this 10,000 does not have an effect on the profit figure. Why? 10,000 has been taken not to the profit and loss statement, taken to another statement called other comprehensive income. 10,000 need not to be adjusted to profit figure, right. Then if you balance this investment account, there will be a further difference of how much? Further difference of 35,000. What do you think it should be? It has to be, unless otherwise the examiner says, it has to be the amount of investments acquired for cash during the year will credit to cash and debit to investment, will put it under investing activities of the cash flow statement. 35,000 should be a cash outflow. Acquisition of investments. Acquisitions of investment should be 35,000. PPE taken, fair value through OCI investments taken. Intangible assets, I have taken the figures to an account, so let me close it up. 127,000 intangible assets. Intangible assets, it's 117,000, rather 117,000. Close it, and the balancing figure should be how much? 47,000. In the absence to the contrary, and if the examiner does not say what it is, what we simply assume is that intangibles for a value of 47 would have been acquired for cash during the current year. You would have credited cash by 47, debited intangibles by 47. We will put that also under investing activities in the cash flow statement, a cash outflow. Say acquisition of intangible assets, acquisition of intangible assets by 47,000 will bring it to the cash flow statement. Investment properties taken, inventories. Inventories are adjusted. Inventories are adjusted not because that gets involved with a cash transaction, that doesn't get involved with cash, there is no cash movement, but to convert your cost of sales included in your profit figure into purchases. But if it is so harder to determine whether the movements of inventory should be added to the profit or should be deducted to the profit, then we will apply another mechanism which you have learnt in your previous A levels. Inventories, what is the change? 127 at the beginning, closing 141, the change has to be 14,000 rupees if I am not mistaken. Inventories are 14,000, increase. What happens when inventories increase? It is like you debiting inventory account and crediting cash account. So, it has to be a cash flow, cash outflow. But remember, what happens in nitty-gritty is not you buying inventories at 14,000 rupees by crediting cash. You do that thinking just to ease your thinking pattern to decide whether the inventory movement should be an addition or a deduction from the cash flow. We will simply do it. Increase in inventory should be taken under working capital changes. Increase in inventory, this is how it should be worded as per the standard. You can't say purchase of inventory is wrong. Inventories increase is 14,000. Under working capital changes, we will put it within brackets. Trade and other receivables, opening 248 and closing 397. Why is it adjusted here? Remember, it is not because that gets involved with cash. We adjust debtors here to transform simply sales from accrued basis to cash basis. But if it is so harder to see whether the movements of debtor should be a deduction from the profit to an addition to the profit, We will apply the same technique as we apply for inventories. Trade and other receivables increase in trade and other receivables. So, what should be the amount? 248, 397. Trade receivables 149 increase should be a cash outflow. It is like you debiting debtors by 149. As debtors increase, you need to debit to debtors, and the correspondent credit is assumed to be always in the cash account. So, it is like you debiting debtors by 149 and crediting cash by 149. Prepaid expenditure decrease in prepaid expenditure. Prepaid expenditure. Prepaid expenditure decreases by 20,000. How do we simply assume that? Prepaid expenditure decreasing is like you debiting cash account and crediting prepaid expenditure. A debiting to cash is like a cash inflow. It should be added to the cash flow statement as a result. Cash and cash equivalent will be taken at the end. Ordinary share capital opening balance 350, closing 400 should be a cash inflow of 50,000 under financing activities, say proceeds from share issue. Proceeds from share issue should be 50,000, should be a cash inflow under financing activities. Retained profit I have taken already, not the profit difference between opening and closing retained earnings, but I have taken the profit before tax. Long term bank loans need to be little careful. Let me open up a simple T account for bank loans. Now the bank loans are included under current and non-current both, depending on how soon they will become due. So, part of the bank loans that will immediately become due should be under current liabilities, and the balance part has to be under non-current. So, that bank loans is scattered under current and non-current. So, let me put them together to bring it as one single balance. Long term bank loans opening balance should be 140 plus 10,000, opening balance 150,000. Closing figure, bank loans 100,000 under non-current liabilities and 170,000 under 100,000 under non-current and 170 under current, altogether 270. Opening 150, closing should be 270. So, what has happened during the current year? 270, 270, 120,000 is the difference. It is like you receiving and obtaining more bank loans during the current year, and let us put it under financing activities, proceeds from long term bank loans 120,000, proceeds 120,000, proceeds from bank loans 120,000 should be a cash inflow. Then deferred tax liabilities, let us open up deferred tax account, take the opening and closing balances. Opening balance in the credit side 75, closing balance should be 90. Deferred tax has increased by 15,000 during the current year. Where will you debit this to? you will debit this to tax expenditure. And let me open up tax expenditure account, tax expenditure. How much has been the tax expenditure during the current year? 44,000. This is what you credited to expenditure, debited to profit and loss. Out of 44,000 current year tax expenditure, 15,000 has to be deferred tax. You know, the tax expenditure is comprising of two elements, current tax and deferred tax. Out of 44,000 tax expenditure, 15 should be deferred tax, and the balance would have been current tax, and current tax figure then should be 29,000. 29, and that you will credit to tax payable account. Leave some space for the opening and closing balances. Debited tax expenditure by 29,000, credit to tax payable by 29,000. 29. Right. Then trade payables, opening balance 105, closing 183. So the difference decrease or increase rather in trade payable should be 78,000. That again is landing under working capital changes. 78,000, 78,000. Increase in trade payables, increase in trade payables, working capital changes. We took it to the cash flow statement not because there is a cash element. Why are we adjusting trade payables is because to eliminate the accrual or accrued element of purchases. So now the purchase figure included in the profit figure is no longer on accrued basis. Now it is transformed and converted into cash basis by adjusting trade payables. 78 was done. Accrued expenditure is it has increased by 27,000 if I am not mistaken. Yes, 27,000. Increase in accrued expenditure 27,000. It once again should be a cash inflow. Increase in accrued expenditure is like you crediting accrued expenditure by 27 and debiting to cash by 27,000. 27,000, right. Then tax payables, let me bring tax payables. Opening payable is 88,000. Closing is 92,000. 92. Fine. Now let me go to the extract of the profit and loss now. Interest. Now interest taken to profit and loss is 23,000. The amount of interest taken to profit and loss is the cash paid interest amount. So how do we conclude that? If the interest taken to profit and loss was different from the amount of interest payment in the year, there would have been interest payable at the beginning or at the end of the balance sheet. I mean at the beginning balance sheet or at the closing balance sheet. If the interest taken to profit and loss is 23,000 and if the closing balance sheet shows interest payable of 3,000, the amount of interest paid during the year would have been 20,000. The beginning or the closing balance sheets not showing interest payable figures implies the fact that, indicates the fact that the amount of interest paid during the current year is the amount of interest that is relating to the current year. So interest has to be added here back to profit figure. That part I did not still explain. Interest has to be 23,000, will add interest here back. 23,000 should be added back. and once again that is deducted from the operating profit. And you will wonder whether I am duplicating the work. It is not a duplication. So, there is a purpose of doing that. What is the purpose? LKAS 7, one reason is LKAS 7 requires us to show the cash flows arising on interest payments. And if you do not do that part, what happens is interest payments of 23,000 remains hidden, and that required information to the readers is not disclosed or divulged anywhere. Just to make it prominent, just for the purpose of, in order to get the cash flow statement to reflect the cash flows arising from the interest payments, I need to add it back to the profit and then to show it as a cash payment separate. That was one reason. The other one, what is the profit I have taken here right on top? The profit taken there is the profit before tax 217,000. And which profit am I supposed to end up at? I am supposed to end up at the operating profit. In the profit and loss, you take the sales figure, cost of sales, and then the gross profit, and then operating expenses, and then you get the operating profit, and then finance cost, and then only you get the profit before tax. Profit before tax figure comes after deducting finance. So, I am starting to convert profit before tax figure from accrued to cash. Then here your profit figure here would have been profit before tax on cash basis, but here what I have written? I have written operating profit. Can you ever start transforming profit before tax figure from accrued basis to cash basis and to end up at operating profit on cash basis? It never happens. Then what I will do is, to the profit before tax figure, I am adding the interest figure back. Profit before tax plus interest will become which profit? Operating profit. Then once again, the amount of interest taken to profit and loss was added back to convert this profit figure from profit before tax to operating profit. Then once again, after calculating the operating profit on cash basis, the amount of interest paid in cash is deducted, and then we further arrive at profit before tax on cash basis. That was the logic. Then the tax payable account is closed up, and to calculate the amount of taxes paid in cash, 0, this is 117,000 taxes paid, and the balancing figure should be 25. That was what was paid in cash, and deduct it from here. 25 is deducted. Right. And please make sure I have taken everything. 217 was taken, 35, 33, 12,000, 35 was taken, 33 was taken, 7,000 was taken, 12,000 was taken, 23 was taken, 14 taken, 149, 20, 70, 27,000. 23 was taken, 25 was taken, 78 taken, 35, then intangible assets. I have missed out one thing, property, plant and equipment account should be closed up, and find out the missing figure. This is 805,000. Property, plant and equipment 805, 158,000. Property, plant and equipment acquired for cash during the year should be 158, put it under investing activities. Acquisition of property, plant and equipment 158,000 should be a cash outflow, we will put that within brackets, 158 was taken. Then 50,000 taken from, that is from share issue, bank loans taken 120,000. I have missed out one, debentures I have not taken. Debentures opening balance 210, closing 175. So debentures have redeemed during the current year by how much? 35,000, if I am not mistaken. Yes, 35,000. 35,000 redemption of debentures. Redemption of debentures. 35 should be a cash outflow. Intangibles, I have made a mistake, should be 57, not 47. Acquisitions of intangibles should be 57,000. So one more item, and this is an interesting area, and you need to be careful at the exam. The examiner can be a little smarter. He sets some traps and you get caught and you are losing marks. Retained earnings at the beginning 315,000 if you look at the opening balance sheet. So what does it say the current year profits are? Current year profit figure should be 173. 173. So what has to be the closing balance? Closing balance would have been 488,000. Closing retained earnings figure would have been 488,000 if the opening retained earnings are added to the current year after tax profit. But does this 488,000 appear in the closing balance sheet? No. So what is the balance of profit that appears in the closing balance sheet? 390,000. Let us see the difference. 0. This is 8. This is 9. 98,000 difference is there. So what do you think that 98,000? That is because during the current year we have paid dividends of 98,000. And that information is not disclosed anywhere, and without you paying the concentration to that item, if you go on balancing, you will get stuck down the line and you will not be able to locate where the mistake is. So you need to do that reconciliations always, especially in the questions at the exam. Take the opening retained earnings, add the current year profit to that and see whether it is adopting to the closing profit figure. If a particular figure is missing, that is assumed to have been the dividends paid. Dividend payment either can be taken to operating activities or financing activities. Let me put it under financing activities. Dividends paid. Dividends paid 98,000 should be a cash outflow. So let me take the totals now. 217 plus 35 minus 33 minus 7 plus 12 plus 23. Profit before working capital change should be 247. Then minus 14 minus 149 plus 20 plus 78 plus 27. Operating profit should be 209. 209. Minus 23 minus 25, then net cash generated from operating activities, net cash generated from operating activities should be 161,000 plus balance. Here 78 plus 35 minus 57 minus 158 minus, here it is 172,000 minus negative figure. Your wording should be little different now. Say net cash used in investing activities 172,000. Then 50,000 under financing activities cash inflow, 120,000 cash inflow, 35 cash outflow, 98 cash outflows. Net figure should be 37,000. Negative figure, your wording should be the same as investing activities. Net cash used in financing activities. Net cash used in investing activities 172, net cash used in financing activities should be 137. Then let me take the final grand total. Let me show it elsewhere. Grand total should be 26,000 plus balance. 26,000 plus balance. What does it say? The entire cash inflows during the year has been higher by 26,000 than the cash outflows. So, we generated a surplus cash balance of 26,000 during the year. Here, see how it is worded. Net increase, you need to be careful about the wordings at the exam. Net increase in cash and cash equivalent during the year. Net increase in cash and cash equivalent during the year should be 26,000. Let me also bring cash and cash equivalent at the beginning. Cash and cash equivalent. Equivalent at the beginning 172. So, we had 172 cash balance at the beginning and we generated a surplus cash balance of 26,000 during the year, and this has to adopt to the closing cash and cash equivalent balance of how much? 198,000, and that is what has to appear in the closing balance sheet years. Then only all what you did seems to be correct. Say for 198, say cash and cash equivalent at the end. Cash and cash equivalent at the end. So, this reconciliations need to be presented as part of your cash flow statement. So, we can move on to the second question now.